So we all know that stock prices go up and down every single trading day, and this is the way that it's always been, but what a lot of us aren't realizing is that the dividend yield is also going up and down every single trading day as well because of the way that it works. So in this video I'll teach you how the dividend yield works, and I'll also teach you how to calculate it on your own, because honestly it is worth looking into the dividend yield. It's just not really as important as we tend to think it is, because when I first started investing I thought that if you saw a 5% dividend yield that meant that you always got paid 5% in dividends no matter when you were investing in that company. And once you discover what the dividend yield actually represents, it's quite a bit different than what a lot of us think. The dividend yield is just the current percentage of money that you can make based on what the company's paying out in dividends relative to their exact current stock price. So basically the way it works is, if you see a dividend yield of 5% and you happen to invest $10,000, then $10,000 at that 5% rate would mean that you'd make $500 per year in dividends, but that's also assuming that you're investing all that money at the exact same time, because if you took that same $10,000 and you invested it a month later, the dividend yield could be completely different. It could be higher or lower, and that's all dependent on the stock price, because as the stock price goes up or down, the dividend yield is also going to fluctuate with it. So if you happen to be looking into a company that you want to invest in and you see that they have a current dividend yield of 5%, then do not assume that that 5% is always going to stay the same, because as the stock price goes up and down every single day, it is going to fluctuate the dividend yield as well. And also keep in mind that if the company you're looking into changes how much they're paying out in dividends, that can significantly change the dividend yield, because let's say that a company is paying out $5 per year a share and then all of a sudden they drop it to $2.50 a share. That can be a significant change to the dividend yield, so just keep that in mind as well. Now you do need to understand that dividends are always paid out per share. So for instance, if you have $1,000 to invest and you're looking into a company that costs $100 a share, then at that point you can only buy 10 shares of that company with your $1,000. Now if the company you invested in happens to pay $2 per share, then obviously with your 10 shares you'll make 20 per year in dividends, and that happens to be a 2 dividend yield. But let's say that you decided to wait to invest in that